And I'm going to get started. I think some more people are going to be joining as we go along, but I'll get started by saying good afternoon, everyone. As we begin today, I'd like to share that eQuo is founded on core principles of unity in diversity, equality, inclusion, and mutual respect, which we believe are important cultural values towards establishing an equal spirit of community. With this in mind, I'd like to thank Rye Barberstock, Wolf Clan, member of the Mohawks of the Bay of Quinte, for being my guide in the following land acknowledgement. I truly believe that understanding comes from sharing knowledge, and Rye taught me that a land acknowledgement is an opportunity to express our gratitude, but it's also an acknowledgement of our positionality and identity, as well as our treaty obligations to honor, respect, and care for the land, water, natural resources, peoples, and the ecosystem which sustain us all. This is at the very heart of eQuo. Our community believes that we're all interconnected in one way, shape, or form, and we must find sustainable means to take care of each other, as well as our planet, by working together. eQuo recognizes that our work and the work of its community partners is conducted on the inherent and treaty lands of diverse Indigenous cultures and nations, including 46 Indigenous treaty agreements in Ontario. We're thankful to be able to work, live, and play on the lands and waters of the dish of one spoon treaty territory, which consists of much of southern Ontario, including Toronto. eQuo recognizes and acknowledges the incredible historic and contemporary contributions made by First Nations, Métis, and Inuit people to Canada and the world during times of peace and war. Lastly, finding meaningful ways to work together and to contribute to the strength of Ontario into rural and urban Indigenous communities is one of our primary goals at eQuo. We're excited about the future prospects of collaboration with Indigenous peoples, organizations, businesses, and communities in Ontario and across Canada. Niawe and Miigwech, and thank you for listening and being part of this webinar. Thank you again, Rye Barberstock, for your time and guidance. Dan Turcott is our producer today, and we want to let you know that we will be taking questions at the end of our session, so please enter any questions inside of the chat box. I'd like to welcome everyone to today's session, Not All Angels Network. This is an important conversation about Canada's changing investment landscape. There's an irony that as entrepreneurs struggle to find funding for their companies, there are just as many investors struggling to find good deal flow. There are 800,000 accredited investors in Canada with a net worth between $1 and $30 million, and another about 200,000 who are above $30 million. Yet less than 10% of these investors are part of any formal investing network. Why? There are many reasons. Many don't want to chase unicorns with business models they don't understand. Others aren't interested in tech companies at all. The reality is that most of these accredited investors have made their money in traditional industries like manufacturing, real estate, agriculture, or retail. They want to invest in companies that have business models they understand with growth projections that make sense to them. There's also a major shift happening as boomers begin to transfer $750 billion to younger generations in Canada. And these younger generations are more interested in wealth planning through private equity and alternative investing strategies than ever before. With the advent of Robinhood, Wealthsimple, and the growing influence of Reddit and other platforms, millennials and Gen Z are a new breed of investor with very different philosophies toward their own individual investing needs. We're going to discuss all of these influences and more with an incredible panel that I'd like to introduce. We're going to start with Brad Rome. Brad was the former CEO of Canadian Black Book, a former ad man like myself, and in recent years an accredited investor who has shifted his focus toward building his own businesses and investing in great founders. Hesse Jones is a strategist, tech journalist, chief of staff for the Better Ethics and Consumer Outcomes Network, and a venture partner with Matter Ventures, a seed stage fund that invests in underestimated founders. Payven Malati is a serial entrepreneur, board member, angel investor, and a general partner for the Archangel Network of Funds, a consortium of Canadian super angels and venture capitalists focused on making investment accessible to entrepreneurs who find it hard to participate in the current ecosystem. Joanne Fedayko is a publisher, serial entrepreneur, founder of Canadian Women's Network, as well as the CEO of Connection Silicon Valley. Joanne is also an investor, advisor, and advocate passionate about entrepreneurs and empowering women by properly funding them. And Frank Wang, a financial planner, analyst, angel investor, and associate at Celtic House Asia Partners, who invest in early stage consumer marketplaces and digital health startups in North America and China. Each of them are also advisors, investors, or advocates for eQuo. eQuo is building the first matchmaking platform that connects small businesses with investors, capital, customers, and talent. There's a mismatch in the marketplace, and founders building smaller businesses, no matter how great or profitable they may be, don't all have the same access to support. eQuo is changing that. With eQuo, entrepreneurs get access to the support they need to grow, while accredited and retail investors get access to great small businesses. eQuo is launching our MVP later in Q1, and we're currently raising small amounts of money from lots of Canadian investors to build and grow our platform. You can learn more and participate in our community at equoshift.com. That's EQUO shift.com. So I'd like to welcome our audience and thank our guests for their participation today. We're going to start with Brad. You're an accredited investor with some large investments in your portfolio, but you haven't been part of any organized investors group. What are you looking for when you determine your next investment, and why haven't you taken part in any formal network?
Well, first of all, Barry, thanks for the introduction and the opportunity to participate today. I'm going to start with the second half of the question, and that's like, why have I not taken part in a formal network? For me, I like to evaluate opportunities where I can dig deeper into the business opportunity. Quite frankly, I want to be able to meet one-on-one with the founders and the key players. I want to have an opportunity to talk to them, kind of, we'll call it over coffee, where they're not putting on the pitch. And a lot of times when you're part of a larger network, they've rehearsed and they've just got that 20 minutes to be able to put the pitch on, if you will, and you don't get an opportunity to ask the tougher questions and be able to kind of dig into their mindset a little bit more. The next thing is, as for what I'm looking for in my next investment, I guess there's really two things that I look at more than anything. The first thing is, I'm a pretty basic guy, so the idea, the opportunity has to be something that I understand and makes sense to me. If I can't understand it or it doesn't make sense, even after I've asked some of the people who may be involved with the business in question, I pass on it immediately. The second thing is how invested are the key players in the opportunity? And when I say invested, I look at three things. The first is passion. Do the key players seem to truly believe in the opportunity? The second thing is time. Is this a full-time commitment? Is in the venture, or are they just operating off the side of the desk and it's kind of something that they're just doing on a whim? And the third thing, which is an interesting one today that can become a little bit controversial, I'm sure, is profitability and or exit. I'm still one of those old school guys that Barry kind of described, where there's got to be a reasonable path to profit or exit, where I'm convinced it'll happen in the time horizon that's kind of been presented, or if it's not, it's just going to be outside of my risk tolerance. I mean, there's been a lot of focus on tech companies, and the growth and the evaluations they're getting, in my mind, are just like completely unreasonable and outside of my risk tolerance. I mean, if I use the electric vehicle companies as an example, if I talk about Elon Musk, he's a brilliant guy. He's done great things for Tesla, but it still baffles me as to why it's valued as high as it is when it's barely making a profit. And you have all the traditional car companies that are doing very well in the electric vehicle space now, and certainly will continue to grow in the future. So it's certainly an interesting dynamic now in a lot of different areas.
I think that's great, Brad. And I don't think that you're alone in questioning how some of these valuations are happening, because you've got some valuations that just seem so unrealistic. And then on the flip side, you've got other companies that you're looking at them, and the valuations seem far too low. I think a lot of the founders would certainly make that comment. So Hesse, I want to ask you a question. You're a venture partner with Matter Ventures, and we met because you had issued a post on LinkedIn and you had commented how you were growing tired of seeing investor after investor stand on stages and talk about all the investments that they need to make for underestimated founders. And then in reality, you kept witnessing that they never practiced what they were preaching on stages. What drove you to make that post? And what do you think needs to happen to close the gap for underestimated founders and investors?
Well, first of all, thank you, Barry. I'm privileged to be here among a distinguished group of investors. So I've only recently entered the VC space under a year, and I've mainly come from tech startup world in the last decade or so. But in the last few years, I've actually been researching a lot about the historical VC funding, especially in North America. And there's going to be one report that I'm going to cite. It came out last year called the Diversity in Startups report that came out of Morgan Stanley. And it scrutinized the top 100 VC firms, which accounted for almost $68 billion in funding and over, I think, 3,300 companies. The upshot of the report was that VC-backed startups significantly were male. That was 90%. 72% were white, 35% were based in Silicon Valley, and 14% were Ivy educated founders. So they cited that some of the issues with respect to lack of representative investment in women as well as racialized founders was that while many of the investors perceived the funding landscape to be balanced, their actual investments in these multicultural and women owned businesses were highly skewed. So investors, for the most part, couldn't see over this risk wall. And they increase the risk wall for racialized as well as women based founders was twice as high than white males. There's also this lack of access. Investors who say they frequently review all businesses equally actually only reviewed businesses from women 17% of the time, and for minorities 18% of the time. From a male perspective, it was almost 50%. And so there's this other area that I want to focus on a little bit. It's called lack of familiarity. Um, a lot of investors who say that they invest in sectors as a compelling driver to traditional businesses, in fact, only defaulted to traditional businesses run by males 46% of the time. And for women, it was almost only 30%, and minority founders 33%. So when we talk about racialized and women-owned controlled businesses, they could account for $6.8 trillion in gross receipts if we start matching the percentage of labor as well as the business revenues that were equal to these traditionally male-founded, male-invested businesses. And that is equivalent to a missed opportunity of almost $4.4 trillion. So what this revealed is that there's actually not a pipeline problem as much as people want to say that. There is no lack of talent in these underrepresented communities. Much of the issue is about access, and there's been a lot of reference and literature talked about where VCs have invested in communities within their own communities and people who look like them. And then when they talk about solving problems, they solve problems based on what they determine as the definition of mainstream. And so I've done a lot of research in AI when it comes to systemic bias, and this is indicative of what that is. This largely ignores a lot of the problems or issues that are already being addressed outside of these bubbles. And they may be endemic to some of these outside communities, but they haven't been thought through or even considered among Silicon Valley based or Ivy educated startups. So when it comes to investing in companies, VCs often say that these companies are not the right fit. And that actually belies the very environment that they're in, because there is a claim for market related issues, but often it's really about the fact that they're not familiar with that market rather than there's not a market available. So every VC has their own strategy and investment criteria when it comes to determining the right fit for their portfolio. And so there's this evolving concept of fit has to also take a look at those that are outside of the sectors and evolving sectors, evolving markets, geographies. We typically bring in people who are subject matter experts in those areas. And so when it comes to companies and products that are run by these underestimated entrepreneurs that address a market efficiency or a need that they've identified, it's based on personal experience. And this is exactly the type of calculated, I would say, expansion risk that VCs have to consider, because there's an overwhelming amount of VCs that were surveyed that actually say that, someone's lived experience, it poses a competitive advantage in determining a market problem that needs to be solved. So VCs likely aren't educating themselves, or they've become complacent in the, in the environment that they live.
I think, wow, there's so much to unpack there, and I think it raises a lot of questions where Frank, I'm going to kind of create a bridge here. When you look at this perception of risk wall and the reality that some of the older, more established investors and funds are really should be looking at rethinking how are they approaching industries, how are they reevaluating and reconsidering certain founders from underestimated groups. You're an associate at Celtic House Partners, but if we take a look not just at the existing group, there's a huge shift right now with millennials, with Gen Z, and that whole notion of the Robinhood and Wealthsimple influences that have happened. How do you think the millennial and Gen Z, who have very different perceptions of social impact, as well as not really looking at underestimated founders any differently, they've got a very different perception of equality in the world. How do you think that they are going to be approaching investing, and how are they going to change potentially some of these issues that Hesse has mentioned?
Um, for first of all, thanks, Barrett, for the warm intro and a great honor to join the great panel and the audience today. If I may, before I answer your question, just want to just anchor on what Hassie was talking about. I 100% agree with her about underestimated founders. I mean, our fund supports many Asian founders and the women founders too. I mean, many of them, just like myself, we don't really speak a perfect English, but we do. Many of them have like extensive experience and skill sets, and most importantly, they turns out understand that underserved community the best. And from our own portfolio companies, it has to prove that they can become unicorns, and it shouldn't be overlooked or underestimated. And to answer your question, and on the perceptions of the new generations on the alternative investing and even investing in general, I mean, if you compare to the same life stage, I do believe today's millennials and Gen Zs not only have more economic power, but also with more resources in investing than any other preceding generations. I mean, the income level are higher, and most importantly, the new generation start investing earlier. I read the data the other day. 31% of the millennials started investing before age of 21 years old, and that number was like a single digit in the preceding generations. And another thing very important that I want to point out here is today the new generations can get much easier access to more asset classes through many different investment vehicles. If you look back in the days, boomers primarily have access to the traditional asset classes such as stocks and fixed income, and no offense, but many are still very risk averse and very cautious on investing to the private equities and the venture capital and angel investing. And on the other hand, in general, the millennials and the Gen Z are willing to take more risks and are way more active in convincing pursuing investing into private equities, and many are sort of tired with the traditional asset classes and key in learning and involving much more in their financial planning and investment process. I mean, my background as a financial planner, in the past 7 years, and I deal with the boomers and their kids, and essentially the millennials and the Gen Z generations. So I kind of saw both sides of their investment philosophies and the mental models there. So if you look at the Gen Z, particularly the oldest age is only like 24, 25 years old right now. I mean, this generation is also called like a digital natives, right? Tech savvy, and grew up with where startups are normal. They're doing everything online through apps are normal. Learn and share on the social medias are normal, and crowdfunding is normal, like investing in eQuo, right? And on the founder with as little as 250. It's not like the old days of credit investor you had to put like $100,000 check in. So the perceptions of the alternative investing, and especially in the private investment space, are very different, I think, compared to the preceding generations. I mean, how is the generation approach investing? I mean, the ground has been set up very well for the generations. Accessibility, information transparency, number of investment products available. I think one recommend I would give is to do more due diligence and understand more about what you're investing in, because today's generation is more influencer driven, right? I would trust a professional network like eQuo over those what they call influencers who are not really like investment professionals on the social media like TikTok, right? In addition, I'm 100% with Brad on focusing on the fundamental value and the reasonable valuation of the investment rather than just the signaling or speculations.
I think that's great, Frank, and thank you. And I think having that perspective that's starting to look at, as you've said, and Brad started to talk about, of the mixing of the generations in a way that we haven't seen before. And to that end, one of the things that I'd like to recommend for everybody that's in the audience, part of our goal is to connect people. So some of you have already started putting your LinkedIn and some connections in the chat. I'd highly encourage you not only to ask questions, but to connect with one another. And speaking of connections, I'm going to jump now to Joanne. Joanne is the founder of Connection Silicon Valley, also the founder of Canadian Women's Network. I got to know her quite well over the past few years, and she's an incredible advocate for entrepreneurs, very, very strong advocate for women. And she has a unique advantage of seeing issues and opportunities from both sides of the border, Canadian and a Valley perspective. And, there's a lot of times that the differences get discussed. I'd like to ask, how would you describe the different philosophies on each side of the border? And where should Canadians start to look at how they can get more from their investments?
Thanks, Barry. Frank, boy, I sure wish at 21 I was an accredited investor. How the world's changing. Equally want to echo just the opportunity to be here. Really honored to be in this room, and Barry, to be able to support you over the years, and excited to see eQuo actually launching. So when it comes to philosophies, I actually don't think philosophies per se are that different, but I do think, to Brad's point, the risk tolerance is very different. And I think that is largely because of just the massive amount of capital that is in the US and some of these global markets. So if we can get more capital flowing in to Canada and amongst Canadians as well, to your point, I think that will have a very positive shift in the tech ecosystem. And what you guys are doing, and other funds, and just getting more of the Gen Zs and others investing earlier on will help that. But I do think there is still a lot more work that needs to be done, because I talk to entrepreneurs on a daily basis, and Canadian entrepreneurs, and it's still a massive roadblock for them. in order to find the funding that they need at that very early and critical stage. And because, of COVID and now being borderless, investors were already starting to look to Canada, obviously largely more of the Toronto, Waterloo ecosystems first, but they're looking everywhere now. I'm excited to say we see a lot more coming into Alberta, where I'm from. But they're really looking to Canadian investment opportunities. And so it gives Canadian investors the opportunity to build a global network for themselves with these US and more global investors. And that just brings a very different mindset and approach, and again, to investing, which I think that will really help on the Canadian investment side of things. We still need more capital, but again, might be able to change a little bit of the mindset around risk tolerance. And also there's this FOMO that happens, right? If you get a Valley investor or US investor investing into a Canadian company, then that perks the interest more of Canadian investors, and they don't want to miss out on those opportunities. So I think all of that will allow the Canadian investors to just maybe, again, bring that risk tolerance down just a little bit, which I think will help the ecosystem thrive.
That's great, Joanne. Thank you. And it's interesting when you talk about that FOMO and American investors taking the lead. I think for a very long time, one of the big frustrations has been that everybody sits back on the sidelines, waits till the American hero walks in, and then everybody comes back out onto the dance floor and says, "Okay, I'm ready to dance." So Payvand, I think that's a really nice opening for you. I mean, you're an entrepreneur who I've respected for a very, very long time. You're an angel investor in your own right, but you're also general partner for the Archangel network of funds. And so we've talked a lot about the ecosystem. You've seen so many sides at a very, very deep level. Where's it working? And where do you think we need to improve?
Let me start with thank you for inviting me, Barry, to this amazing discussion and panel. I have the privilege of being the last person, so I learned a lot about the rest of the panel. A lot is changing. We're in a very exciting time, especially in Ontario and the rest of Canada, from the investment in startup companies. If you compare it to 9-10 years ago. So if you look at the amount of VC capital that comes is huge. We are growing significantly, and I think in Ontario we had about $7 billion VC investment last year, which is very, very encouraging. But the devil is always in the details. So if you look at these large investment and you look at it, you see that 70-80% of it is Series B, Series C, large investment, which indicates that, again, that risk tolerance that we all, I think Joanne was referring to, is not there. And the early stage companies that are essential and the engine of these startup ecosystem it only gets a very small portion of these large VC investment. I think there is quite a few things that needs improvement. One of the things that Brad mentioned as well is I think we're oversimplifying the due diligence and also the selection that we're doing. We're trying to mimic a lot of the selections that happened. It comes from Silicon Valley, basically. We're trying to give entrepreneur 8 minutes to pitch, and then it's like everything is rehearsed when we want to invest into the companies. And then we overlooking a lot of good companies, and we're creating these trends that everybody that has a SaaS, we're going to invest, or everybody that has this recurring revenue, or just to oversimplify this. And a lot of good companies gets missed. As I mentioned before, as if somebody today comes and say, I invented LED, nobody will invest because the first thing is hardware. It's capex intensive, and there's no SaaS in it, so we're not investing base. So you might miss such a huge change in the world because it doesn't fit that oversimplifying or categorizing the investment on early stage companies.
I think that's a really, really good point, that the whole world today seems to be driven by SaaS, by tech, And two of my previous companies that I'd sold were SaaS. So I fully support them. Um, but at the end of the day, there are a lot of other incredible companies, and we've all individually had conversations where, whether you're in agriculture, whether you're in food, whether you're in retail, whether you're in manufacturing, they are increasingly being forced or adapting a tech-based focus as well. So, Frank, I'm going to throw a question out at you. Do you think that the different investing philosophies that we've talked about from millennials and Gen Z, do you think that they're also looking for, just tech, or do you think that they're a bit more open, or generally, how do you see them shifting the whole investing landscape?
Thanks, Barry, for that question. I mean, um, it, it really depends how you define the tech company. I think that we generally talk about this, right? Like, I mean, traditional industry companies are innovating with different technologies. So I believe that eventually every single company should become more tech enabled, right? So, and to the Joanne's point and Paven's point, my our founder, whole team are millennials and Gen Z generation, and we invest in Canada and the U.S. and then we start shifting our a lot of focus back into Canada. We see a lot of underestimate founders here, and see the investment landscape definitely are changing. So I mean, if I recall correctly, it used to be only like 99 LPs are allowed for a fund, but now you can have like hundreds of LPs, and both credit and retail investors can invest in the private equity and VC deals through SPVs and crowdfunding, especially. The space is becoming uh, more commoditized, which going to result in more competition, right? It doesn't matter in Canada or US. As an investor in VCs, and what I truly believe will work in the long run is to become a more thesis-driven investor instead of like just a signal-driven and network-driven. Just being expert in the limited number of fields and focus on fundamental value of the business and mental model and skill sets of the founders, regardless of the color, and that will be the key to the success. And if you look at it on the flip side, more competition and the funding means more opportunities for the entrepreneurs to access the capital, which is definitely going to be a good thing for sure. In terms of the ways the investment landscape is changing, one great example currently, I mean, we have seen a big trend in the ESG investing, sustainable investing in the both public and private investment space. That is primarily driven by new generation of investors. I mean, millennials and Gen Zs have greater concern over the climate change and social responsibilities, right? So, I know I want to come back to that the first question the first point you pointed out, whether the millennials and Gen Z only look at the tech companies. I mean, I think that's a miss. It's not just like we only look at the SaaS company. You had to be a SaaS. We're going to invest in you, right? You can be a traditional industry company, but you're utilizing the existing technology, have the great future, and what I believe today's generation are very open to learn different kind of industries and learn about traditional industries. I think the entrepreneurs, when they pitch in their companies, probably shouldn't really say, consider, first off, you shouldn't even consider yourself not tech companies, right? Just put out there what you're changing based on the new generation, transforming your company into a new level, right? So hope that answered the question.
No, I think it's great, Frank, and I think when you're talking about, not necessarily, I'm inferring, I think, from what you're saying, but don't jump to the conclusion just because they're young, they're only focused on certain areas. And in fact, I know for us at eQuo, we've been talking with a lot of entrepreneurs who tend to be under 35, and the breadth of what they're involved in, the companies that they're launching, whether it's in food, whether it's in clothing, whether it's in events, whether it's in design, it's huge. So Joanne, I'm going to ask you a question because in addition to you seeing both sides of the border, you're really seeing a pretty broad range of entrepreneurs with all the things that you're involved in. You're probably seeing more entrepreneurs than the rest of us combined on a daily basis. From your experiences, what do you think that the need is out there, and how can we start to close that funding gap?
Yeah, we work with a lot of founders through our accelerator programs and our networks, different relationships and programs that we've run. So one very tactical thing, which I think is super key to these Canadian entrepreneurs, is to really understand who their target investor is. And we unfortunately see that they don't know who their target investor is. They might know the Canadian investors, but again, going back to that risk appetite, it's low, so they will sort of exhaust that market. And they often will say, well, I don't know, I don't have any network in the Valley or in US. Well, you got to go get it. And it just takes time, a lot of time. But as you start to reach out and do research and connect with people, you will grow it. And it might be slow in the beginning, but it's the reason why you need to like build that network before you actually need the network. And it's also why eQuo is like so critical, because I can't tell you how many times I get the email that says, hey, I'm coming to the Valley, or I'm fundraising, and who do you know? Well, I don't know. Who do you want to know? Who are your target investors, within your sector that are investing at that stage, size, that geography even. So the single most important thing that entrepreneurs can do is actually carve out time on a weekly basis to figure out how they build their network. And they can go through resources like expat Canadians to start, alumni networks, accelerator, cohorts that they've been a part of. There's lots of great places for them to start with it. So I think if they did that, that would be huge. And then they should sign up for eQuo.
I agree. So equoshift.com. Thank you, Joanne. Brad, you and I had an interesting conversation, and we were talking a lot about generations, but I think not only do we have more young people than ever before from previous generation starting to invest earlier. There's an interaction that's really interesting. And so I mentioned earlier, $750 billion are being transferred. And at the end of the day, we're starting to see this involvement of Gen X and millennials, not just on their own, but from parents and their kids or their families, almost forming a micro family office of some sorts. What are your thoughts on this, and how do you see this continuing to evolve?
Well, this is a really interesting one. In my mind, there's a huge opportunity right now to put Canada at the forefront. We got to give these future generations hope and support by investing in their businesses and startups right now. I mean, that's an obscene amount of money when you think about it, that's sitting there in a lot of cases. I guess the key thing is it doesn't have to be a lot of money to be investing in some of these smaller companies to get them a great start. But, I guess the big thing was, and I think what Barry's probably alluding to, is a conversation I had with my daughter who's in third year at university. And, she told me that her and her friends are concerned about the future. They're in debt from going to school. They're worried about how expensive things are. And they're really a little, I guess, intimidated, afraid, whatever you want to call it, about the lack of support and funding, especially when it comes to, entrepreneurial ventures and things of that nature. So it was really interesting because I described to her what eQuo was going to be offered to entrepreneurs, and she ended up having a smile on her face, and she said, that's exactly the kind of support that we need for future generations. And, for me, that just reaffirmed my decision to invest in eQuo. And I look forward to having the opportunity to look at and evaluate some of the other companies that eQuo will attract that use the system and the processes that eQuo will be able to provide them. So it's a huge opportunity, but I think the key thing is a little goes a long way, and we got to find a way to encourage boomers and Gen Xers who have the money to start investing now and not waiting.
Yeah, I agree that the having all of this wealth sitting in bank accounts as opposed to being able to put it to good use just feels like a complete waste of resources. And so, Payvand, you got lucky. You seem to be last question here, and then we're going to open things up, Dan, to some of the questions from the audience. What recommendations would you pass along to a new investor? Because I think the reality of having 90% of our accredited investors not being part of a network is certainly unfortunate, and we want to help change that with platforms like eQuo. But what it also means is they're not necessarily understanding or trained or educated in how to go about investing and how to conduct due diligence. Do you mind sharing some thoughts?
Absolutely. Um, one of the benefits of COVID is you can get educated on this investment groups really easy now. Instead of it used to be like if you want every region has its own local angel group or early stage groups that you need to travel to that place to be in a selection or something. But at this point, you can easily attend a lot of selection or due diligence meetings as a guest and getting education through that is the best way to get involved in this early stage investments. So my recommendation is just sign up to the selection committees and due diligence meetings if you can get in as a guest and see the deal flow, see how the questions asked from the entrepreneurs and the reaction, what's the base of the investments. And then if it's your cup of tea, basically, then you can start investing or joining one of these groups or the funds basically to start investing. That would be a much easier and it mitigates the risk of the very first investment in this early stage companies.
That's fantastic. Thank you, Payvan. And one of the things that we'll do is we'll organize on our side a list of some of these organizations and places and share that out with the group. So what I'd like to do now is first, I'd like to thank all of our guests. I think some fantastic information, great feedback. Appreciate your time and preparation for today's webinar. Really appreciate your time today. I'd like to encourage everybody to learn more about eQuo. You can go to eQuoShift, EQUO, shift.com, register as an alpha for our launch at the end of Q1 of this year. If you're looking at potentially becoming involved as an investor, we have a crowdfunding campaign that's currently in play at frontfunder.com/eQuo. And other than that, I really want to thank the audience for spending the time with us today, and thank you very, very much.